What's up, everyone? Welcome to the Daily Macro Update for Tuesday, September 9th. Taking a look at some of the macro data here today, we received the annual non-farm payrolls revision that showed a deceleration by 911,000 jobs. So, yeah, this is essentially the government saying, yeah, we overestimated jobs by nearly a million, right? If we take a look at the past 2 years, it is over a million jobs that were revised, right? Or revised downward. And so, if we take a look at this chart right here, we can see that over the past, couple years, this is well over, or actually since 2023, this is nearly an overestimate by, over 2 million jobs, which is quite concerning, right? How can that happen? What this is showing is that this is a major supply imbalance in the current labor market right now. And this cannot be solved with rate cuts. Rate cuts are a tool to solve a demand problem. And right now, even though you are seeing some hardships with, people having difficulty finding jobs, you can still see charts that show that the amount of the unemployed level versus the amount of job openings, there are still more job openings comparative to the amount of unemployed people. And so you're seeing just a large exodus out of the labor force, mainly due to retirements, as well as people, either staying in school to get their master's degree or just people exiting to do other things. We really just haven't seen this type of, supply issue in the labor market in the United States for quite some time. Really, actually, this is the first time that we've seen this in modern history. So, yeah, this is going to cause problems if, the Fed starts to aggressively cut rates in order to try and solve a supply problem with a demand solution tool. Now, this will continue to fuel the narrative as well as fuel a lot of the speculation that's been happening in the market still, because again, stocks going up pretty much are pricing in dollar debasement as well as long-term inflation remaining higher. And so, as you can see here, there is a 91% chance that they're only going to cut by 25 basis points. So, even though we continue to see negative jobs revisions, you actually saw a shift from a 50 basis point cut, or I think it was a 12% chance of a 50 basis point cut yesterday. It's now just an 8% chance. To me, that's a move signaling that the Fed might be a little bit cautious with continuing to cut rates from here. All right. So, yeah, we still have inflation numbers coming in this week. Tomorrow is producer prices, and then on Thursday is consumer prices. Just take a look at some of these dumb headlines here, right? So, U.S. stocks gain as weak jobs data fuels Fed cut bets. How can it's kind of bass backwards, right? Typically, if we're having a weakening economy and stuff like that, then, stocks would actually come down, right? But I think the stock market is correctly seeing that if the Fed starts to aggressively cut rates into this supply constrained labor market, that ultimately is going to fuel or keep inflation elevated, which, if companies are able to maintain margins and their payroll is reduced, then, hey, you know what? Then they can still make as much money as they want, right? It's the same reason why, if a company announces layoffs, that the next day you see the stock actually go up on that layoff announcement, because the market is trying to price in the savings that company is going to have because of reduced payroll, right? It's all about the context. And right now, the context that the market is saying is that, hey, labor market isn't too crazy, and it's more of a supply issue. So that's what is currently happening right now. And so again, it doesn't make any sense that people are calling for rate cuts for a lot of the weakness in the labor market. If you want to solve the weakening, or if you want to supply this, I'm talking too quickly here, getting ahead of my skis. If you want to solve this supply issue with the labor market, you have to have major immigration reform in the short term. And then in the long term, you have to figure out a way in order to incentivize the birth rate to rise in order to replace a lot of the baby boomers who are exiting the labor market. And we're currently not doing that right now. So you're just seeing the entire population level come down. Some people cheer that. The problem is that you're not going to have that might in the short term cause things to rise, but in the longer term, that's going to have a very large drag on the economy and pretty much just promote a longer term stagflationary environment, which that's part of the reason why gold has been signaling what it's been signaling, right? So this is a huge stagflationary signal right here that gold is doing with this current breakout that we're seeing, right? So that's pretty much what I saw here today. Yeah, pretty crazy announcement. The majority of the negative jobs revisions were in things like wholesale trade, retail trade, professional business, services, as well as leisure and hospitality. That's where the major amount of revisions, negative revisions, were coming from. You actually saw some positive gains in transportation and warehousing, as well as utilities, which is pretty interesting. But yeah, the majority of it was in leisure and hospitality, as well as professional and business services, which is not necessarily what you want to see for a healthy economy. Typically, with the United States being a majority service-based economy, you want to see businesses and services start to increase in jobs. But again, you're not seeing that. Let's see. I also saw this interesting piece too, because the other big development that's going on right now is obviously the housing market. And over the past 4 months, we've seen a large acceleration in home prices, or I'm sorry, deceleration in home prices, acceleration in the amount of major metro cities recording month over month price declines, right? So if you're someone who is starting to be in the market of potentially purchasing a house, whether you're doing that for the first time, or you're someone who is just trying to, move for whatever reason, we are starting to see a lot of interesting data here in recent home prices. So I think going into 2026, this will probably end up continuing because, again, if inflation remains sticky, the Fed's going to have to do this stop-go type of method where, we've been seeing this already, where at the end of last year in 2024, you saw the Fed cut by about 100 basis points between September and December of 2024. Well, and then after that, they stopped for an entire, 9 months. You could see that continue to happen where they cut for maybe a couple months and then they pause and then they cut again and then they pause. So we'll see what happens. And, they have their quote unquote neutral rate around 3.5%. So even if they cut from here, that means that in order to hit their neutral target, they're only cutting by 100 basis points more. And a Fed funds rate at 3.5% means that mortgage rates are probably going to stop going down around, 4% or so. That is much higher than what we saw over the past 15 years from 2008 to 2020, right? So what that means is that the average interest rate is going to remain a lot higher than what people are used to, until you see a large recession happen where they have to drop rates to the floor again because the economy is just spiraling out of control. And so I don't think there's anything, I don't think a soft landing is possible at this point. It's just going to continue this like semi, you know, no landing area that we're doing right here. So again, structurally higher inflation, structurally higher interest rates because of these supply shortages. And again, the Fed cannot solve supply issues in the economy with their demand tools. They only have demand tools. They cannot produce more businesses. They cannot produce more workers. All that has to come based off of these longer term demographic shifts. So, yeah, and with the way that the current country has been ran over the past 20 years, I don't care what party you identify with, both of which have been just super hyper focused on short term thinking. Democrats, Republicans, they're not thinking long term. All they think about is the next couple years before the next midterms or 4-year election. That's all they think about because they're only obsessed with power and being in office, right? And so, yeah, until our government starts to think long term, then a lot of these issues are going to keep persisting. And we're just going to have these booms and bust cycles until something really bad happens. But until then, there's still ways in order to capitalize on a lot of this, right? Sectors that are performing well right now not only are precious metals like gold and silver, a lot of the great mega caps are still performing well. Nvidia went down to the low in the trading range, and it looks like it's about to have another acceleration here. You had Broadcom have a large spike just a couple days ago, as well as Google. Berkshire also having a nice little correction here. Let's see. This is getting close to the low of the range. Not yet. So BRK.B is definitely on the list, and I'm almost ready to pull the trigger on that one. Tesla also looks like it's consolidating here, about to have some type of breakout. So look at that. Look at that chart on Tesla. Tell me what you guys think in the comments below on this sort of thing. You are seeing an interesting decline in volume right here. So, typically when prices are inching higher on lower volume, that is technically a bearish divergence. So, we'll see what happens from here. If it's able to clear this price level right here, which is $362.44 with Tesla, then and we start to see that on higher than average volume, then that's a huge signal that it's going to be going probably to all-time highs. Conversely, though, if it does break this trend on higher volume, then that would be a more bearish signal for Tesla. So, moment of truth happening with TSLA coming up here. So that's kind of what I'm seeing on that front. Still in a very much risk-on environment when taking a look at the consumer discretionary versus consumer staples ratio that my team and I like to look at. Not only that, though, I mean, we also see credit spreads remaining incredibly tight. If we take a look at that here, let me just bring it up. Yeah, so credit spreads remain bearish. You have bearish bond yields, right? So the 10-year and the 2-year also remain bearish. That is going to steepen. As long as the 2-year drops at a faster rate than the 10-year, that's going to cause more of the bull steepening that we've been seeing over the past month or so. Mortgage rates still remaining pretty high, at 6.5%. Not as high as where the peak was all the way back in October of 2023 at 7.7, but still, again, a lot higher than what we've seen since 2008, right? So, and this could remain higher, as we've already talked about many times. The volatility index of the S&P remains pretty muted there. When looking at the VIX over 3-month VIX ratio, again, it's near 0.8. These are great times in order to raise cash, in order to buy on the next dip. Still can't believe that the majority of retail investors remain bearish given in this environment. I can definitely understand because of all of the narratives that are running out there about recessionary fears and all that stuff. But, when it comes to this market, that is mostly driven by passive fund flows and a lot of these structural issues that we were talking about. You can't ignore the trends, right? The trend is probably the strongest signal in this post-pandemic environment. It's not necessarily fundamentals or things like that. It's a lot of that is the passive fund flows. Um, Lastly, when it comes to central bank liquidity, we've seen a large decline in central bank liquidity because the RRP is all dried up. The Treasury General account continues to rise. They're going to try and get that to 150 billion by the end of the month. So we'll continue to see a drain on net central bank liquidity for the rest of September, which could be putting some more headwinds on the price of Bitcoin. So you could see that continue, but things that are doing well in the crypto space, such as Bitcoin miners, massive 11%, almost 12% move today for Bitcoin miners. Looking at the Bitcoin miner ETF WGMI, that is a huge spike on a very large, accelerating volume there. That is, I mean, as a bullish of a signal that you can get. And then interestingly, with Ethereum, you're starting to see some lower volume on some price declines here. So again, Ethereum is having this little sideways price action, slightly downward on lower volume, which is a bullish divergence. So things like Ethereum, Solana, AVAX, all of these cryptocurrencies look really good. Bitcoin is actually bearish in our model currently. So interesting dynamic there, but not surprising because when we translate that to the regular markets, you're starting to see small caps outcompete the Mag 7. So looking at the Russell 2000 index, look at this. There's another strong bull market right there. So yeah, one thing I forgot to mention in my previous video is that you have to remember, though, the reason why things are going up isn't because of value increasing, right? The reason why prices are rising is because of a devaluation of the dollar at the end of the day. Because if you denominate the S&P 500, so if you denominate the stock market in a hard currency that's able to retain its value in relation to inflation, you get a much different picture with the way that the stock market has been performing ever since the pandemic, right? So in order to do that, instead of denominating the S&P 500 in US dollars, let's denominate it in gold here. And so as you can see, looking at the S&P 500 versus gold, it's at levels that we haven't seen since the pandemic, right? And so, really, when going back to, on a weekly time frame here, ever since the peak in 2021, the stock market has been bearish, right? And this is a testament to gold just being a massive outperformer from the traditional stock market over the past 3 to 4 years. But yeah, I mean, when taking a look at this, the S&P 500 has never really gotten to the levels that we saw back during the dot-com bubble. Someone would use that as a way to say, hey, the S&P 500 could continue higher from here. Well, the thing is that it's possible, but the main driver of prices these days is just because inflation as well as dollar devaluation is just getting out of control. That's really the only thing, right? So putting this in housing terms, it'd be like, a house that is really old. Maybe it was built in the 70s, has a lot of problems with it, needs a bunch of upgrades. Well, even though nothing has changed with that house, with the condition of that house within the past 4 years, for whatever reason, the price is up, almost double or, 80% in the past 4 years. Yet the roof is still leaking. It needs a new air conditioner. The floors are nasty. Old style cabinets, needs a huge upgrade on the pipes to PVC from cast iron, right? All these things haven't been changed, yet the price is doubled. This is the sole reason because of the government and these central banks with their insane policies have been devaluing the dollar. And so this is part of the reason why, like, I talk to, some friends and family members where it's like, it's not just looking at and participating in the stock market in order to try and find some hot stocks in order to make some money. No, like you have to use the public markets as well as private markets, right? Real estate, other things in order to preserve your purchasing power over time. Because if you just hold cash, you're going to lose out. You are going to end up not being able to sustain yourself and your family. So you have a moral obligation in order to combat these central powers by investing your money wisely. It's not an option at this point whether you should be in the markets. Okay, if you're just holding cash, even if you're just putting it in a high yield savings account, with it collecting 4%, that might be out competing inflation, but again, you're also paying some taxes on that gain in in terms of your income tax. So really, even though your gross gains on that money is being able to compete with inflation, after taxes and fees on those high yield savings accounts, you're still losing just at a less rate. Okay. So in order to get that extra juice, you need to be investing more strategically in the markets. So let me know if that makes sense. I've gone on now a 25-minute yapping spree. So we can go ahead and get into some questions here. Can you please take a look at MP ranges? Well, yeah, I mean, we're going to start to say that with certain stocks on here, if you want the ranges for individual stocks, then we're going to reserve those questions and answers for people who are in our macro investing community. I'll still be able to provide ranges on these live streams for the major indices as well as the 11 sectors of the S&P and the top 10 stocks in accordance to market cap. But when it comes to these, I need to start only reserving the ranges for people who are in our community there. So that's a new policy that we're going to start having here. So you can still ask ranges again for the top indices, 11 sectors, and top 10 stocks. But what I will say is for something like MP, I mean, this does remain bullish. Yesterday you said natural gas was bearish. Could you explain how? Thank you. Did I? I don't think I did. I'm pretty sure I said natural gas was bullish. Or no, I'm sorry. Yes, you're right. Natural gas is bearish. What's the reasoning for that? I mean, what you're seeing right here is a series of lower highs and lower lows. I mean, you're seeing a series of higher highs and lower lows on a much larger time frame. If we take a look at volume, I mean, volume has been accelerating on this decline. Let's see if we take a look at, let's take a look at 30-day volatility. You are starting to see volatility start to decline, which is a good rate of change, but still, you're still continuing to see a series of lower highs and lower lows on this, on a longer term trending time frame. So yeah, I mean, a lot of that is showing that this is a bearish trend. Also, I've been subscribed to the online course for 2 weeks now and have been unbelievably successful. The trading view indicators and online courses are super helpful. Thank you. Yeah, no problem, Matthew. I'm glad you're finding success in it so far. And yeah, we'll get you up to speed, man. Glad you're finding it successful there. And, for those who are wanting to get involved with learning a lot of this these macro strategies that my team and I use for ourselves and our own personal accounts, I would highly recommend going to our website, macro-optics.com, and checking out our 7-day trial of our macro investing community. Is XLU still bullish? No, actually. So in our model this morning, XLU actually went from neutral to bearish in our model. So, yep, XLU is now bearish, and the ranges for those, the top end of the trading range zone is $84.79, and the low end of the trading range zone is $81.80. So yeah, XLU just went bearish there. All right. What can be the last call before something really bad will happen? I don't know. That's me trying to, predict the future. And you know, the thing is that there's a lot of these risks that are out there, obviously in the markets, but it really doesn't make sense to try and predict when those things are going to materialize in a way that's going to shock the markets. Because between now and then, you could have, a continued large move in the markets that you don't want to miss out on. So with this, it's a game of continuing to dance as the music plays until the music stops. Keep on dancing. What are some ETFs right now that you are bullish on? Well, I mean, I can just share which sectors that we're currently bullish on for the S&P sectors. The tech sector, bullish, financials, consumer discretionary, communications, industrials, energy, as well as materials are all on our bullish list. What do you think about stablecoin profitability going to buy back the US debt? I'm not sure what you mean by that. Appreciate it. Lamanos Kamiki. I don't know if I pronounced your name there correctly. For someone who is looking to purchase slash build a home soon, would you advise them? I don't know. I'm not really in a position to advise you to do what you're on with your own money. I'm not necessarily a financial advisor. But I know in some states there's actually a lot of incentives from the local governments or even your state government to encourage new home building, right? So you might even get a break. Who knows? So I mean, it really just depends on your personal situation. Um, you know, um, it just really depends. So it's not necessarily a yes or no, black or white answer on whether or not you should purchase or build a home, right? So yeah, I would just check and maybe reach out to your, preferred realtor and just ask them what they think, you know? Tesla has been consolidating for about a week now. You said there's a lack of volume for its current price. Do you believe that this is market manipulation or something else? No, I just think it's just regular market dynamics, and it's just something that you have to notice. When when prices are increasing on lower volume, that's just something that you have to take note of. And so, yeah, I mean, I see that volume is decelerating while historical volatility, still remains in a bearish trend, right? So you have the blue 30-day over the orange 90-day. That is still good. But, you could potentially have a situation where if volume spikes back up, you could actually see something like this happen, if a spike goes up. But I mean, again, it really just depends because you could also see this too. This is one of those things where, you know, technically Tesla is in a bullish trend, right? So the trend in our model is bullish. So that's something that's good. It would have to take some type of weird thing to happen for it to go down. And so, I'm leaning for it to continue to accelerate, but this is something where I probably just want to wait and watch to see what happens. Kelly Star King, thank you for sharing your content. I've been following you for a year. Well, thank you, Kelly Star. Appreciate it. Hopefully, you've been getting some value here. But all right, we'll go ahead and end it there. I know that some people actually were. Let me see some of your guys' comments here on TikTok. Thoughts on AMD? AMD has been having a little bit of a deceleration. I do think it's. I do think that it's something that's going to continue higher in the future, but I just want to wait and see what happens with AMD. Johnny, do you think the job numbers are bad due to all the government jobs? I'm not sure what you mean. Do you mean like the government job declines are the main contributor? They are, but I think that you are seeing a large number of, I mean, recently a lot of jobs cuts uh, have been from the government jobs. But again, when looking at this table here over the past year, you can see that the majority of job losses have been in the private sector, right? Not from the government sector or public sector. All right. Well, we're going to go ahead and end it there, everyone. I appreciate everyone for joining. Have a great rest of your day, and I will catch you in tomorrow's daily macro update. Bye, everyone.